And if you've never heard this before, here's how it works. A business earns money, it pays its expenses, and then it pays tax. So if it pays the money to you, that's an expense. Then it has no tax. If you don't have to report that money, you have no tax. Voila. Tax-free. Tax-free money. Normally for us, we make money, we have to pay tax, and then we spend what's left. That's what withholding is all about. You go get a paycheck, they always take the taxes out, right? So in English, we need to have an employer with employees. You cannot do this with a sole proprietor. You have to do this with a corporation. And again, I'm going to write every one of them up. I want you guys to actually remember this. And I'll just do this in a darker color. You need to be an S Corp, a C Corp, a LLC taxed as S Corp or C Corp, or a 501c3, a nonprofit. Any of those. And that's what our operating business is going to be. It's going to be one of those. It's never going to be a partnership. It's never going to be a sole proprietor. I guess I shouldn't say never. I mean, like, rarely, unless that partnership was owned by S Corps. You know, that's the only time that would come into play. But I don't want to get too, again, into the weeds. As a general rule, this is it. So anytime you say, hey, if I'm going to operate an RAL, not the real estate, not the loan to get the thing staked. If I am just going to operate, I just want to be an operator. I said, you know what, I'm going to get my family together and we want to make sure that we're good operators. You want to be an S Corp, C Corp, LLC taxed as an S Corp, LLC taxed as a C Corp, or a 501c3. The employer gets to deduct any money it gives you. You do not have to report the reimbursement. I love that. Corporate reimbursements, by the way, there's a ton of them. There's education, there's startup and organizational expense, there's travel expenses. Your cell phone, for example, let me just give you an example. Right now, if you're paying for your cell phone out of your individual pocket, it can reimburse 100% of whatever your cell phone costs are because the business needs you to have a cell phone. So you can reimburse 100%, not some portion that the business uses. It says, hey, Toby, you need to have a cell phone. Fantastic. I'll reimburse the whole thing. Legally, the business could be required to reimburse it. In other words, they don't care whether you already have one. It just says, hey, if they need it, you can reimburse it. Computers and equipment. You get your kids involved. Now, all of a sudden, all their equipment, you can start writing off. Internet. You say, hey, you know what? Now I'm going to need high-speed internet. Anything that you have costs. If you don't need anything extra, I'm going to show you how to capture a portion of it through the home by using an accountable plan. We have subscriptions for any magazines, or if you're going to join any associations, business meals. So if you go out and you spend your own personal money and if you realize, you know what, that was a business meal, you can reimburse yourself. That employee home office, that's a big one. It's actually called an administrative office. Everybody recognizes home office. It's not the same thing as a sole proprietor. This is different. And then medical, dental, vision, and long-term care. If you are a C Corp, it's 100%. If it's an S Corp, it gets included in your wages, but you get to write off as self-employment insurance, just the insurance value on your personal. Even with all this, this is where I get, what the heck? Over 70% of the businesses in the United States are still sole proprietors. And that's going back to the reading test. The accountants don't see it. They learned under a different format. Before all these rules came out, before 1993, for example, you didn't have administrative offices for the home. You didn't have this check the box regs until 1997. So a lot of folks that have been practicing for a long time aren't even aware of all the rules. No harm, no foul on them. Maybe they're doing individual taxes. Somebody says, I'm just looking for all this stuff. Well, it's amazing, brilliant. Oh, thank you. I was trying to figure out what that was. And I was like, that's amazing. No, we want to make sure. So you want to have that accountable plan. Corporations also receive preferential treatment. And then we'll get to the last one. So I'm just going to do real quick, apples to apples. Again, precision matters in this one. I'm going to show you if you make $250,000. This is all of the calculations, and this is using tax calculation tools. Everything that we could throw in here, we threw in to say, what's the end result? Without doing any of the accountable plan, without doing any extra deductions, without doing anything else. If we didn't do any of that and we just did apple to apple, on a $250,000 business, you're $7,000 ahead per year without even doing any of the actual extra stuff, just on the fact that S corps pay less tax. It's $7,000, about $7,000 a year. If you're making $50,000, hey, I'm not doing much, a ton. The difference is still about $4,000 a year. A little bit more than $4,000 a year. If you're only making $25,000, you're still making an extra $1,500 a year. And remember, the bookkeeping on these, the books and records requirements are identical. The only cost you have is technically you're doing 1120S tax return. It's actually easier to do an 1120S tax return than a Schedule C on a 1040. I actually can put them side by side for you if you ever wanted that. I actually do that in the 3-day class. I actually show you line by line form difference. It's faster to do an 1120S than it is to do a Schedule C. People say, oh, the S corp's more complicated. No, same books and records, faster return time, cheaper. But you have to do a payroll. That's the only thing. But you're going to save yourself, even on a small one, even at about 25,000, it ends up like, I don't know why you wouldn't. $1,500, I'll do a payroll. Even if it costs me $100 or $200, I'll still take that action. And then corporations can pay their own tax. And, C corporations, I've said this a few times, under the Tax Cut and Jobs Act, it went to a 21%. A lot of people and a lot of accountants, they only look at the S and the C, but it is possible to do the tax-free. This is the 501c3. And that's where you're doing a charity, which you can do with REL. Have fun. I love doing taxes. There's one other tax deduction I want to show you. Oh, real quick, just so you see it. This is an S corp versus a... Wait, this is not the S corp. This is the S corp right there. That's an S corp versus the Schedule C on a 1040. This is the Schedule C. Oops. This is the Schedule C. See if I can pick a better color. Schedule C, and this is S. Which one looks more difficult? This is your 1040. This is what you're doing. This is what they all say. Oh, yeah, just do that. It's so much easier. That does not look easier to me. It looks like a lot more. It's crazy. Anyway, let me get you to the fun part. I want to show you one or two more things, and then we'll get into legacy planning because I don't want to run out of time on that. You ready for something crazy? This is kind of a typical thing that we do. I use what I call Toby's cheat sheet, and I add up all the things that you can't write off individually, and I start adding up like the SALT deduction and things like that. It's done some really amazing things to harm New York and Connecticut and Maryland and California, some of the high tax states. They denied them a lot of stuff. So we usually look and say, here's all the things that we're able to reimburse, and then we figure out what the value of the deductions are. So we always look at a tax appetite. I always use this guy, like, hey, what's your appetite? How much do you want? Well, in this case, this person could save about $29,000 a year. Yeah, it starts to add up when we add all those things up. But the big one for me, you're already spending money on your house, whether you rent or buy. But here's the actual calculations for it. And I'm going to show you the IRS's calculation too. You look and you say all of our direct expenses. And here, I circled that wrong. This is anything, if I take a room in my house and I say this is going to be where I'm going to do my business. And I put my business there. And my employer, now my S Corp or my C Corp, says, hey, I'll reimburse you for that. because you're using it and you're using it my benefit. Anytime the employer benefits from it. An administrative office doesn't have to be a principal place of business. It doesn't have to be your main office. It's where you do your administrative activities. So it's where you're doing your bills, or you're doing your executive, hey, this is where I do my board meetings. This is where you do your accounting, if you're going to do any tracking of your books and things like that. But I have a space. Let's say I take one room, and let's say that I have 4 bedrooms or 3 bedrooms or something, and I take one of those rooms. If I paint it, if I put wiring in it, these are called direct costs. I get to reimburse these 100%. The indirect cost is going to be a percentage, and this is going to be a percentage of my usage. And unlike a sole proprietor, we don't look at the gross square footage. We're going to look at the net square footage, or we're going to do the room methodology. We're not stuck like a sole proprietor is. We can use up to 9 different methods. The best ones I'll show you. But we look at our mortgage interest, the PMI, the real estate taxes. We're going to look, if you're a renter, you could use that instead of those. Homeowners insurance, utilities, including your electricity bill, your water, even your gas if you have it, your internet. If it's hey, I'm already got internet in the house and I'm just piggybacking off of its wireless system or whatever, I'm going to use that, and I'm just going to use my portion of it. I can even add in if you have a house cleaner comes in and cleans once a month, and they come in and do a deep clean, you can add that into it. If you're meeting people there, you can actually do your landscaping too. Somebody says, does this apply if you rent a house? Yes, it does. What we would be doing is just putting in your rental amount. So if your rent's $2,000, we would just plug that in. And then your repairs and maintenance, anything along those lines. And you're going to come down to this little number here. I want you to remember that. These are the indirect. This is what it costs to operate my house on an annual basis. Remember, the real estate taxes are up here. You're going to say, well, I already write off my real estate taxes. You get to reimburse yourself. Especially if you're over $10,000, you're not getting to write that off anymore. You're exceeding the SALT deduction. In addition, you get depreciation. But this isn't depreciation that you have to recapture. There is no recapture, unlike your home office as a sole proprietor. This is a reimbursement, non-taxable, does not get included in your tax, does not affect your taxes 1%, 0. So you look at the house, how much my land value is, how much my basis is, the basement of the structure itself. That structure is going to last 27 and a half years, according to the IRS. So I'm going to get a reimbursement based off of a percentage of the house. So I'm going to look at it and say, it's 27 and a half years, it's 2.54. If I put it into service in this one was year 5. So I'm going to go down here and say it's year 5, and what month did I put it in? June. So you go over here, and I'm going to grab this number right here, which is 2.564%. And I'm going to multiply that, and I'm going to get an extra $10,000. Now, I don't get to write off $10,000. I get to write off whatever percentage of my house that I'm using for that office times the $10,000. So then I add all these things up. So my total indirect expenses, I'm looking at $27,000. Plus, I'm going to get an extra $600. I could use, hey, I have a 10 by 15 room. So I could just say my exclusive square footage. I'm going to get rid of my hallways, my garage, and things like that, and say, hey, this is a big house, 4,000 feet. I don't know about you. I live in a 2,400 square foot house. I'm not a big house person. I had a big house, and in Vegas, it means a big electric bill. Like utilities suck down here. So I was like, no, me and my wife, my 2 cats. So usable square footage, we do that calculation. It's, about 4%. That stinks. Then I do the number of rooms method, and I say there's about 6 rooms total. The family room is 1, and all the bedrooms, and maybe I have a den. So I would have 1/6, which is 0.167. I'm going to tell you, There's been cases where they've been as high as 40%, 50%, 60%, or 70%. People use the garage, for example, to store merchandise. The MLMers get huge breaks on this. But what it gave us is $5,000 tax-free. Write a check, company writes it off. I get to take that money tax-free, whatever that's worth to you. Now, in addition, I'm going to show you another one. And again, this is going to freak you out. I'm going to show you another way to get about another $10,000. So on average, our clients do reimbursements under these ways of a little over $20,000 for folks that are making less than 7 figures. You get over 7 figures, you start to bump into the 100,000 on an average. But let's just say regular, not the super high net worth, it's about $20-some thousand a year deduction. So it depends on what your tax bracket is as to how much benefit it is. The 280A is this section. Here's the actual code. And it just says disallowance of certain expenses in connection with the business home, rental of vacation homes, etc. You look at it and you go, how the heck could that be good? Well, you go all the way down to the bottom, and it's subsection G2. The ones we actually care about are right here and here. And all they say is, notwithstanding any other provision in this, or section 183, I looked at 183, it has nothing to do with what we're doing. So it's just this section. So ignore anything you just read. If a dwelling unit, I'm going to give you guys the highlighter again, where you can see it. If a dwelling unit, notice it doesn't say your primary residence. This could literally be anything that you live in during the year, is used during the taxable year by the taxpayer as a residence, which means you stay overnight in it. And by the way, residence can be anything that has a sleeping quarter, a head, and a galley, so even boats. And such dwelling unit is actually rented for less than 15 days. Then, this is what we care about, the income derived from such use shall not be included in the gross income. And section 61 is your adjusted gross income. Or excuse me, 61 is actually gross income. It's not even adjusted yet. So it's just all of your income. It's not even included. It doesn't show up. What does this mean? It means you could rent your home out for 14 days a year and you don't have to pay tax on that income. Airbnb was really good at using this. But who should you rent to? How about your own corporation? It's a separate taxpayer. And yes, the courts have said you can do it. This right down here. If we're just doing $750 a day. And by the way, do you have to have meetings under a corporation? You have to have at least one. But you're allowed to have monthly. But some corporations have multiple. And you are an S-Corp employee. Yes, somebody says unaccountable. You are automatically an S-Corp employee if you're greater than 2% shareholder and you're doing anything for the business. And what percentage of the business reimbursed cell phone is personal use? 0. You can reimburse 100% of it. Can I reimburse the student loans and tuition if my son works for the business? No. As there's a rule on how much benefit goes to you and your siblings, so it doesn't, or you're not your siblings, but your kids. So you have some issues there. But yes, we can reimburse you as an owner who is an employee. IRS says we can do it. We've already fought this on audit twice in 23 years. It didn't trigger the audit, but they came up and they wanted to make sure it was a reasonable amount. That's all they cared about. In the middle of South Dakota, or North Dakota, excuse me, steam cleaning business, it was $500 a month, and that was over 15 years ago. In Florida, it was about $1,100 a month. So I used $750 because I actually called around to a few hotels and said, hey, based off of my house, I'm just going to rent my house. You can do both the administrative office and the 288. We show you a bunch of other of these. I just wanted to give you guys a taste because we will show you how to keep money. We'll show you how to keep money in your pocket. All right, legacy, and then I'll let you guys go. Whenever we're doing a legacy, and is a director of a 501c3 considered an employee? Yes. And yeah, can they do the accountable plan? Yes. You guys are like some of you guys are getting it. can do all of that even if you rent. Somebody says you went too fast. That's why we teach a three-day class on this, guys, and that's why you come to Tax Tuesday. There's so much information on our website, and we'll handhold you quite a bit and give you these. I always tell people I teach a tax class for 2 days straight. That's just nothing but tax strategies. I say just try to get 3. Try to get 3. I teach 30. So just try to get 3 of them, and then come back and get another 3. Come back and get another 3. There's a ton of it. What we're going to just go over is Dynasty, avoiding probate, and how you can pass on and preserve assets for your heirs. The number one thing to do is dream about what your values are and what you want to pass on. And I'm not talking about money, guys. Forget about the money. Think about the values. The money can bring the value. If you just give somebody money, it's going to be gone. 70% of the situations, it's going to be gone within a matter of 2 or 3 years. It's going to be gone. It's not going to be there. The stats are pretty clear. 16% of the money will be left in 5 years. Most of it's just going to be gone. And it's because they didn't earn it. There's a big difference between having a purpose behind a dollar and not. And the example I give is if I gave you $1,000 and said this is for your son or daughter or grandchild, you treat that money differently than if you'd won $1,000 down at the casino. It's just human nature. If something's earmarked for something, you treat it differently. And so it's being very clear about how to earmark. And the thing is there's only one way to do that. You can't do it by going through probate. Probate is a die and distribute. Probate is die and distribute, and it stinks. It used to be necessary, but we don't need it anymore. And frankly, it's a really good way for lawyers to make money. Probate lawyers do very, very well because they have an 18-month on average case, and they're billing an estate. It's not really my favorite. The way to avoid probate is using a living trust. That's the easiest. Life insurance also doesn't require probate, although I would generally put the beneficiary as your living trust, because you don't want to give money to somebody because you don't know what their situation is going to be. We've seen people kill themselves within a week of receiving an inheritance simply because they were suffering from drug addiction, depression, and we just watched themselves push over the edge. In fact, in one particular case, my partner was Greg, excellent financial planner, used to be a partner here. He wanted to do the financial planning thing. He can't really do both. So he's still out there doing his thing, but he was working with a gal, and he knew, based off of her conversations, that her son he was really struggling with drug addiction, had gone through multiple times, and she says he's doing well now. What do you think set him off? His mom passed away, and he actually overdosed within a week. We're like, the guy had everything to live for. There was actually a pretty sizable estate. You don't know who you're dumping money onto and whether they're going to be able to handle it. So the life insurance payouts, I still say put it in a trust. Your 401k IRAs, if you don't run it through the trust, creditors of those beneficiaries could take it. You could do paid on death accounts or transfer on death accounts with certain bank accounts and things, but we still suggest that you do the living trust. You could own it joint tenancy. So husband and wife, I'm cool with. I'm not cool with joint tenancy with one of your kids or with an unrelated person, because you're on the hook for anything they do, and that property could be taken away, and they could even try to remove you from the property. And then if you don't own it but you control it, like through a charity, then that's how that's how it was passed on to those kids. They want to make sure that they couldn't sell it. Can you do a living trust for a relative that already has dementia, or do they have to have lucidity? It depends on whether they have a power of attorney where they allowed you to do the trust. Most would have to be specifically stated, otherwise it would likely be too late. And I had a father who passed away from sundowners, had Alzheimer's. And so I know how long and how horrible that is. And my heart goes out to you. But you got to have those documents ahead of time. I wish there was another way. What we do know with windfalls is it also if you leave money. They've done studies at the Ohio State University. Lottery winners save just 16 cents of every dollar won. And the bankruptcy soared after 5 years. And then 70% of wealthy families, people that are multimillions, lose their wealth by the second generation. And the reason that most people don't even make it that far is because what we do is when you're running around, you have a generation is about 30 years. So you're just getting into the really good stuff. And then you pass. And on average, according to AARP, says 20% goes to cost, plus you've sold the asset, they're liquidating it. So a good chunk of this just took, on average, I would say it's about a 30% hit when you die and distribute. Can a living trust be the managing member of an LLC? The living trust doesn't act by itself. It's actually a trustee. So the answer is yes, but it would be you as manager or you as trustee of the living trust. And then if something happens to you, you can actually specify an individual or a company. Dynasty, everybody says, what is a dynasty? You know, I say there's a dynasty. To me, a dynasty is a family that's been successful for a long period of time. The reason that we have to do some sort of estate planning is because you can't take it. So you're the, can you transfer an RAL into a living trust? Yep, absolutely. You can make it to where none of your stuff goes through probate if you don't want to. You can keep it all private. So, for example, for some of you guys, go look for Frank Sinatra's information about his estate because you won't be able to find it because he had a living trust. Then go and look at Elvis. You'll be able to see everything. Or, go look at what's going on with Prince. Still in probate. Frank Sinatra's handled quick. And this is what's weird. Living trusts are cheaper than probate. In fact, in California, the probate cost, I think I may even have it in here, their statute, the probate cost on $1 million property that even has debt is going to be about $30,000. Living trust might cost you $3,000 for a married couple, and you only have to do it once. So, and then somebody says, what about a dynasty trust? A living trust can become a dynasty trust. In fact, when I set them up here, and they become 365-year trusts that can decant for another 365, decant again for another 365, and so on and so on and so on. They are dynasty trusts. A dynasty trust, when it's irrevocable and you start it during your lifetime, is a fancy way of somebody saying, hey, I kind of want to charge you a lot of money, and we're going to call it a dynasty trust. It's nothing more than just a trust. A trust is a trust is a trust. It's a grantor, it's a beneficiary, and a trustee. Whether it's defective for tax purposes and irrevocable, whether it's freely revocable like a living trust is, you can change it anytime you want. It doesn't file a tax return. Until you're passed away, it doesn't become irrevocable. They're fantastic tools, guys. And they're becoming more and more common. When I started doing this 23 years ago, always had trouble with trusts. Because people are like, oh, I heard it's not that big of a deal. No. It's a big deal. And now it's becoming more and more common because the internet, you can see all the horror stories. Look, lawyers are making well over $2 billion a year probating trusts. You can eliminate that cost from your family. And I always think like this. You're not taking it with you. This never happens. And it took me a while to even find that picture. Rehearsed with it, right? You're just a steward of the wealth during your lifetime. And then you're going to pass it and give it to somebody else. And then they're going to be the steward of it. And you can do that in one document, a living trust. And by the way, that's what all the dynasties done. When families have been successful over a long period of time, that's what they do. They take the ability of future generations to screw stuff up. So I always think that moms out there, hopefully there's still a bunch of moms out there, the problem that you have is that some sons have broken pickers. And I don't mean this type of picker. I mean the picking of a spouse, right? And they might pick a few times. They might make some mistakes. You don't want your estate to get eaten away in case they do that. And women can do it too. But we always like to make fun of the guys. But moms know when the son's about to marry, we call it her that woman. You know what I mean? So the most prevalent case or the most notorious case was the 90-some-year-old who married a Playboy playmate, Anna Nicole Smith, and tried to give all of his billions of dollars to her. She was 28 and he was 90-something, and he passed right away. That's called having a broken picker. Yes, your trust can own the LLC. Your trust can own everything. Absolutely. You own it as a trustee. It's like if I was going to own something in my living trust name, it would say Toby Mathis, trustee of the Mathis Family Trust. So I would just transfer my